What is the maximum loss for a ratio put spread? Have you ever wondered how much you could lose with a ratio put spread? This strategy can be a bit tricky, but understanding the maximum loss is key to managing your risk. A ratio put spread involves buying a certain number of put options at one strike price while selling a greater number of put options at a lower strike price, all set to expire on the same date. This approach is often used when an investor anticipates a moderate decline in the underlying stock price. So, what happens if the stock price behaves differently than expected? If the stock price remains above the higher strike price, which is the strike of the long puts, all options will expire worthless. In this scenario, the maximum loss is limited to the net debit paid to establish the position. For instance, if you open the spread for a net debit of $1 per share, your maximum loss would be $1 per share. Now, let's consider a different situation. If the stock price drops significantly below the lower strike price, which is the strike of the short puts become deeply into money. This can lead to substantial losses because you have sold more puts than you own. The losses from the short puts can exceed the initial debit paid to enter the position. To calculate the maximum loss, you generally look at the difference between the higher and lower strike prices, then add the net debit paid or subtract the net credit received if the spread was opened for a credit. This calculation reflects the worst-case scenario where the stock price falls well below the lower strike, causing the short puts to incur large losses. For example, if you buy one put option with a strike price of 60 and sell two put options with a strike price of 55, and you paid a net debit of $1, your maximum loss would be calculated as follows. The difference between the strikes is $5 plus the $1 debit, leading to a maximum loss of $6 per share. If the stock price falls for below 55, you could potentially lose up to $6 per share. It is important to manage the spread carefully. If you maintain the integrity of the spread and do not exercise or close the long puts early, your maximum loss will be limited to this calculated amount. However, if the long puts are exercised or closed improperly, losses could be larger. In summary, the maximum loss for a ratio put spread is typically the difference between the strike prices plus the net debit paid or minus the net credit received. This reflects the risk associated with the short puts being exercised if the stock price drops sharply below the lower strike. If the stock price stays above the higher strike, your loss is limited to the initial debit paid. Understanding these dynamics can help you navigate options trading more effectively.